Howdy, y'all. Welcome back to High Trail Tax, where we help you with tax tips and also helping you figure out what the heck is going on with the IRS. So, I got a new one for you today. So this is going to be the Roth IRA account. So if you're not familiar with the Savers Match programs, it was created a few years ago back in 2022, and the idea was it was essentially a non-refundable tax credit, right? If you were lower income, lower to middle income, you could essentially get like a deduction off of your tax, right? It was a credit, so if you were zeroed out, you couldn't get a refund on it, which is what a refundable credit is, but it's a non-refundable credit. It would help low income people and it kind of encouraged them to save money. So to enhance the program, the government, as part of the One Big Beautiful Bill, decided, hey, we're going to offer folks an even better deal. We're going to actually have government matching. So up to about $2,000, we will match about 50% of your first 2,000 in contributions. So that we're trying to encourage people who are low income, who historically either don't have a 401k or don't have savings, to go ahead and save that money. Now, there are, of course, catches to that, which is why we have an article here, because you really thought the government was just giving you free money. Okay? So we're going to find out here. So if you are a lower and moderate income worker who contributes to retirement savings, the new account, which does kick off with the 2027 tax year, so January 1st, 2027, might help you out there. However, not everyone's going to get it. You're going to need to get a different account, which I'm going to explain in a second. So it was authorized in 2022, which provides a matching annual contribution of up to $1,000 for single filers or married filing separately and $2,000 for joint filers. They can receive the benefits whether they save through a workplace plan like a 401k or an IRA. Now you're probably wondering what the catch is. See, they're even so nice right there. Although contributions to an IRA may qualify workers for the match, any money the worker is entitled to can only go into a traditional IRA, not a Roth IRA. Okay, so you're probably saying, well, what is the difference between a traditional IRA and a Roth IRA? So a traditional IRA or IRA, I'm going to call it IRA, basically it's an individual retirement account. And what that means is essentially get essentially it's tax deductible. If you're a worker with a traditional IRA, you basically contribute some money from your paycheck or from your self-employment earnings into a traditional IRA. It's essentially coming off of your tax bill, so it's essentially adjusting your income. It's going to impact your AGI, and then you get to put it away for later. Later in the future, when you withdraw that money, it gets treated essentially as income. So a lot of folks, for example, get a 1099-R, and all of a sudden, all that money they put away, now it's coming back to them, and they pay tax on that. Essentially, it's earned income. Now, a Roth IRA is the opposite. Roth IRA is essentially a non-deductible contribution, so you're essentially paying for it up front, if you will. Okay, but in exchange for that, when you withdraw that money, then you don't have to pay any taxes. It's a non-taxable event in the future. Okay, as long as, of course, for both, you wait until you're at least 59 and a half, unless you meet certain qualifications. Now, why would you get one of those? Well, typically, which we'll explain in another video, traditional IRA is a good choice for mostly people who are either lower income, middle income, and who really need the tax savings now, right? Maybe you don't have a lot, maybe you're concerned you're going to owe money, so you put some money away for retirement, and you essentially agree, I will pay taxes in the future when I presumably have more money. Okay, but in exchange, then I need the savings right now. The Roth is the opposite. Typically, people who go for a Roth IRA are people who expect to be much wealthier in the future and they don't want to pay taxes on that, when they need to withdraw. So they're willing to put away money now and essentially take it on at the time of contribution so that they can reap the benefits later. Okay? Now, here, however, they want you to get a traditional IRA. So we're going to explain why that matters. Okay? So they're going to say a White House official said in an email response to a CNBC, who's the publisher of this article, the expectation is ultimately to allow for both traditional and Roth IRAs. However, it could take an act of Congress to allow the money to go into a Roth. So the idea is that they're trying to say that people who are lower income, I guess they're not banking on a lot of people becoming significantly wealthier in the future, but you want to push out the payment. So what you're going to do is you're going to open up a traditional IRA. You're going to basically deduct the money right away. You're going to make a tax deductible contribution to your traditional IRA. And what that will do is it will essentially allow you to it'll essentially modify your AGI and it will essentially lower your tax bill. Now, in the future, you'll pay for it, but that's, way down the road for most people. The idea behind it is I think they're trying to just get people to save money so that you can get ahead of it. However, the flip side is, what if you want a Roth IRA? What if you expect that in the future you might become significantly wealthier? So, for example, somebody who's starting out who thinks like maybe someday I'll be CEO of the company, or maybe someday I'll have my own successful business. I don't want to get hit later with taxes the way you will with a traditional IRA. So, that option, however, is not available to you. So, you have to keep that in mind. That could change by the time you watch this video because Congress might decide to modify it, but as of now, not. So who will qualify for the match? So single taxpayers with annual income up to 20,500 for the 2026 year, or sorry, 2027 year, or joint filers earning up to twice at 41,000 will be able to qualify for the government match equal to 50% of the first 2,000, okay, for a maximum yearly match of 1K or 2K for the married couples. Okay, and you also get reduced matching, so this is essentially a threshold. So between 20,500 and 35,500, you will still get some of the matching. It'll be phased out, if you will. So it's a phase out for joint filers up to 71K. It will end the traditional Savers credit, which will be available through the 2026 tax year. Okay, so this year in 2026 is the final year you can have it. So anything you want to do with that program, get it done by December 31st. Okay, but it is essentially so you can do it on your next taxes, but you won't get it going forward. Okay, yeah. So this summarizes who's going to get it and why. Is this program right for you? Well, if you are lower income, if you're middle, maybe lower to moderate income, and your employer does not have any type of 401k, any type of retirement package, you don't have one separately for you, this could be a really good fit. You will look, the government is printing up money anyway. You might as well get your slice. So the government will go ahead, will give you your slice, and you can basically get a little bit of help with retirement. But make sure that you check trumpira.gov. They're going to help you find out what's going on here. Make sure that you're qualified. Make sure that your income matches. And if you have absolutely no idea whether or not your income matches, get in touch with me. Contact information's in the description. This is what we do. I work with a lot of people who have IRAs. I have both traditional and Roth, and I can absolutely help you navigate through this, as can High Trail Tax. So that'll do it from here, guys. Just like and subscribe. Ring that notification bell so you don't miss any of my videos. There's a lot of stuff that we like to cover here besides taxes. I do appreciate you joining me on this one, and I'll see you on the next one. All right, see ya.